let a few more people in here before we get started. All right, well, good morning, everyone. My name is Andrew Harris. I'm the president of Liberty Insurance Associates in Millstone Township, New Jersey, and I'm also the president of PIA of New Jersey. And I'm very proud to moderate today's discussion. Today, we're going to have a deep dive session, the topic being the state of the industry theme. So we hope to cover several aspects of the insurance industry. Our presenter today is from Marshberry, an industry consulting organization that provides a myriad of services in the independent agent industry and industry in general, and collects and disseminates large amounts of relevant data that can help manage your business as well as understand some of the driving forces behind issues impacting the distribution channel and marketplace, which is why we have them here with us today. They do offer a range of other services, and I believe we'll touch base on some of them later on. We hope today will be enlightening and will provide some data that will help to grasp some of the whys behind a lot of what we're seeing day in and day out as agents and carriers. I'm sure we've all experienced a lot of challenges, especially this last few years with the hardening market, changing landscape of the agency distribution channel, inflation, reinsurance issues, weather-related events, natural disasters, the regulatory environment, customer expectations. There's really an ever-growing list of things that we're targeting. So we only have an hour scheduled for this event, and that's a pretty tall order to unpack the entire industry. So in the interest of time, I just want to get right to it so that we can endeavor to cover our whole presentation. Hopefully, you'll have some questions as we go through it. If you do have any questions, please feel free to use the chat feature, and I'll do my best to address them as we go along. We will be providing links during the presentation for various different topics, and I believe the presentation will also be available after the fact in a recorded fashion. So with us today is Brian Rafisi. His title is Vice President within Marshberry's Financial Advisory Team. As part of his responsibilities, he acts as a client-facing lead on M&A projects and financial consulting projects, strategy and implementation of client deliverables. Prior to Marshberry, Brian was Assistant Vice President of Investor Relations at the Hartford Financial Services Group, where he was tasked with a number of roles that you will be able to see in his bio. He maintains the FINRA Securities Industrial Essentials Exam designation, in addition to Series 7, 79, and 63 FINRA registrations through Marshberry Capital. Brian earned his MBA from the University of Connecticut and his BS in finance from the University of New Haven. So without further ado, I'm going to welcome Brian Rafisi to.
Well, awesome. Thank you. Thank you, Andrew. Great to see some really good participation here. So appreciate the opportunity to speak. I'm going to make sure that I can share my screen as hopefully the tallest order of operation for the day. So let me know if at this point you all can see.
Good to go.
So I'm just making sure I have that on my side here. And you can all see the screen?
Yes.
Perfect. Well, again, thank you. Andrew, thank you. PIA, I am a personal fan of the PIA. I've perhaps come across a few of you in Atlantic City over the past few years, between New York, New Jersey, and then I live here in Connecticut. So I've had the opportunity to publish in the magazine as well. And as soon as the opportunity came to join New Jersey in the deep dive series, the opportunity is one I couldn't pass up. So at Marshberry, just 30 seconds on who we are for those of you that don't know. And Andrew, again, I appreciate you introducing us. But at the end of the day, what we really want to be is your trusted advisor, whether that is, and we'll get into our learn, improve, and realize, but to the extent that you want to make decisions and you just want to bounce and have a good sounding board, we really look for that opportunity to be that trusted advisor in both insurance, brokerage, and wealth management. Again, this is just rereading it. My QR code is down there, and I'm happy to meet up with you all directly or via LinkedIn, which is where I think this QR code would take you. Marshberry, what we really believe is that we can service, and that goes back to the trusted advisor conversation, anything for what you need in insurance and insurance distribution specifically, both in the US, on the continent, and in the square mile in London. So our reach is truly global and our expertise is truly local. I make the joke that everybody says all politics is local, all insurance is also local, and we really take that to heart with kind of our coverage throughout the US and then on the continent as well. If you think and step back and look at who we touch across insurance and the insurance value chain and now into wealth advisory and retirement planning, there's a lot of overlap with what we see in the demographics of the space, and we're going to touch on that today as well. I mentioned it just a minute ago, learn, improve, and realize, and we're going to touch on a few different things relative to our consulting practice, relative to what we're seeing in the marketplace for best practices, and then at the end of the day, we really also want you all to be successful. Like, you belong to the PIA and your independence is very important to you. So the realize component on here isn't necessarily realize an external sale, but how do you perpetuate? How do you think about the next generation and creating value for that next generation internally, if that's also what you're looking for? So we truly believe, I like to say, we're an inch wide and we're a mile deep in these focus areas. And whether that is our market intelligence, our thought leadership, our management consulting, or investment banking, we're truly here to support you all. Here's a quick Marshberry by the numbers. If you look at our just professional hiring, a lot of that is producer hiring. We talk about valuations and internal perpetuation. We're going to talk about Marshberry 360 here in a minute, which is the 4,200 that we've attends our events specifically over the past 10 years. And again, just some more high-level stats. The idea of putting all these numbers, other than the colors and big bold white, is a lot of the things that we do with data and analytics, and that we're going to talk about today, we do that through the lens of lots of data that comes to us through these magnificent numbers. So, and then the last one here on the sell side advisory. So that's enough about Marshberry. Again, happy to answer any specific questions in the future, but as Andrew mentioned, we only have an hour. So for the sake of time, I wanted to actually transition to, I know this is a deep dive by definition, but I feel like it's not fair to go deep unless we talk about the macroeconomic environment. So I always like to start with macroeconomic factors, and thanks to Investopedia, we can see that general definition. As we think about the last 15 years, this is a really interesting slide because we have truly had 15 years of smooth sailing, whether that's interest rates, economic growth, leverage ratios, the rate environment, the political landscape, tax rates, and deductibility. At Marshberry, one of the things that we've been bouncing around is, has it truly been a super cycle? We've definitely seen the longest run of GDP growth for the last 15 years, excluding COVID. We can talk about the reasons why here in a minute, but it's been a phenomenal growth. We've seen record levels of claims, inflation, social inflation, nuclear verdicts. So that's not great relative to the first one, which is, continued exposure base explosion, but that's the offset. And we'll talk a little bit about that. And then obviously when we're thinking about increasing frequency and severity around CAT, as well as non-CAT losses. The super cycles continued in the admitted hard market. Again, I've been in the industry long enough to know that there was a soft market for a period of time, and there's no direct definition of a hard market. Our definition of Marshberry's 3% or more rate year-over-year rate increases. And if you're looking at that over a period of time, crystal ball is, I also don't see that disappearing anytime soon. We're seeing this. 3%. Go ahead.
We would love 3%. Right now, I'll sign up for that all day.
Yeah, I mean, loss cost trends are at 3% with just inflation and the price of goods moving up, and between fiscal and monetary policy in I'd say all-out boxing match now, trying to keep those inflationary numbers down, but pressure coming from both the fiscal and the monetary side to think about where that all actually unfolds, and we'll talk about that in a minute too. Specialty distribution. It's interesting that we're seeing a mix of a mix shift, I'd say, away from admitted markets and into non-admitted markets. That's something that's happening at the national level as well as at the local levels. I'm sure everybody on this call and in New Jersey is experiencing that as well. And we can talk a little bit more about that. And then finally, unprecedented capital market support. We've had just going back to the 15 years of really easy monetary policy, probably in a way that we're never going to see again. So there's been a lot of interesting, I'd argue, good news and tailwinds into our sales, relative to the last 15 years. And, sometimes the best gauge of that is when you actually look at what the public market investment looks like. So one of the things we talk about, and I'll come back to this in a minute, is we're in the greatest industry in the history of humankind. And not only do we believe it, but if you actually look at where um, professional money managers are investing, they're investing in the P&C insurance distribution. And our broker composite is basically all of the publicly traded brokers out there. You can see the relative performance over the past 5 years of that compared to pick your favorite index. And in this case, we've plotted a couple. So again, it's not just what we believe, it's what the public markets believe as well. And not only that, if you actually step back and you think about the public broker valuations as a function of EBITDA, one of the things we talk a lot about in this industry is earnings before interest, taxes, interest, depreciation, and amortization. The reason we do that is it's the best proxy for free cash flow, and it's just an easy metric because I think, as you all know, we don't have, at least on the distribution side, heavy balance sheets weighing us down like they do on the company or the carrier side. So if you actually plot the enterprise value to EBITDA of public brokers, you'll see that the expansion from up above partly is due to the growth of the actual multiplier below. And you can see in 2009, on average, these are trading at about 9.4 times EBITDA enterprise value. And in 2024, we actually closed in that composite index of 20.4 times. So the multiple itself actually doubled over that period as more and more people realize that this is the greatest industry in the history of humankind. One of the other reasons it's actually the greatest industry is because it's so stable. So those of you that follow capital markets, the concept of beta is a relative term on how any given segment performs against all other segments and where that volatility comes in. And as you can see, kind of less volatile to more volatile as you look across the screen, we've got insurance, property and casualty kind of sitting next to food and power. So as far as stable industries go, P&C insurance is right up there. Obviously, when you think about the opposite side of that spectrum, you get into semiconductors and retail and some of the other more volatile sections. So we're in a really stable industry. We have a lot of, I'd say, tailwinds relative to the 15-year super cycle. And not only is the equity market actually taking that into account, but so is the debt market. So if you think about a balance sheet, having strategic debt and making sure that you're looking at your capital structure correctly, over time, you can see not only the public brokers, but we've actually seen this green bar, which is this expansion of private broker debt offerings. And that is to some extent, along with the private equity money in the space, what's fueling a lot of the consolidation trends from the demand side of the equation. So a lot of people are interested in lending into this industry, both debt and obviously on the equity side. What's interesting about that is if you actually step back and you think about that 101 billion that occurred. So again, on this slide above, the 101.5 billion was on a trailing 12-month basis, what was issued through January of 2025. And when you break that down one step further, you can see all the big names that you probably already have heard of issuing debt. And it's important because that debt is used for a variety of reasons, not least of which is including acquisitions of smaller agencies, and not only smaller agencies, now acquisitions of larger agencies. I think we've all seen the most recent Gallagher Assured Partners transaction. So again, just to double down on the fact that this is a really interesting marketplace and the capital providers on both the debt and the equity side of investor likes it and continues to invest in it. I mentioned it before, but here's another look at the increased capital support on the equity market. So it used to be, and by used to be, I mean 2008, 2009, you could literally, it was a baker's dozen or so of the number of active private equity investments in insurance brokers. As of 2024, there was 103 active funds in our industry. And again, supporting the demand side of the equation relative to consolidation is really fueled by the debt that I just talked about and all of this new private equity money that continues to come in. So A lot of continued strength in the marketplace as we think about the P&C industry working towards profitability. Now, as those of you who have to file your statutory filings on the carrier side or the company side might know, there's always this lag between when we'll get 24 data, but actuals here through 23, we expect the 24 statutory data to come out soon, but we're expecting it to actually be an sub 100 combined ratio in the industry. Part of that is just because of the strong earnings calls that I was listening to and my colleagues were listening to kind of coming out of Q4 and into Q1 of this year from the major carriers as well. And then we talked about the public markets broker side too, but all kind of talking about increased organic growth, increased profitability across the board. Now, again, on the company and the carrier side, you're not getting there without the rate increases, and you can see the red line and then the gray shaded area that shows the continued year-over-year increase. Now, what's interesting about the forecast on this slide, and Andrew, as you just jumped in there and we're talking about, there's probably a deceleration of the year-over-year rate increases. But again, even thinking about just staying in touch with loss cost trends, if loss cost trends and inflation is thinking about north of 3%, which it's hard to argue that we're not north of 3% now, the year-over-year rate increase is just to make sure that the companies are writing below 100 on a combined ratio basis, kind of has to be there by definition. So this is as close to a crystal ball as I'm going to come about what we're seeing in the future, but it's some version of less increased rate over time.
I'm sure if we got a little bit more granular as far as the regional jurisdictions and that type of thing, that'll be stratified differently. But this is just the industry as a whole, right?
Yeah, absolutely. It's the industry of the whole, and it's obviously property and casualty. We're going to get into a couple slides here where every time you talk about a hard market in property, you can't ignore that it's a soft market across a lot of casualty lines. And the workers' comp guys and gals on the phone who are like, "This is not a hard market." I appreciate that as well, because we're actually seeing continued soft rate in comp and comp line and other casualty lines. One of the other big macroeconomic factors that's in part, I'd say that is delivering strength back into the P&C industry is the reinsurance capital is returning. I think, Andrew, you mentioned that there was a pretty deep dive from the Guy Carpenter folks last year relative to reinsurance. Obviously, there was that dip down both on traditional and alternative capital kind of coming out of COVID into 22. But thankfully, the reinsurance markets are opening in capital and sidecars and ILSs and some of those other kind of instruments that are used to provide capacity to give some relief on the primary carrier side has returned. We mentioned Guy Carpenter. They actually put out a rate online index, which we track, and you can see there's some positive trends. In this case, when rate online is coming on, it's because there was this at one point gap between where reinsurance rates were and where the primaries were willing to pay for it. And that's why there was a little bit of a retraction relative to the reinsurance marketplace who didn't feel like they were getting the right risk adjusted return. So that is positive news, again, coming on to more rate online in a more friendly reinsurance environment. I mentioned this earlier, and this is the visual representation of a growing excess and surplus lines risk as it moves out of the admitted markets and into the non-admitted markets. You can see the tick up basically coming up to about 20% of the total. And this is the commercial lines. We actually see a similar trend on the personal line side as well. And we're forecasting that through 24 and beyond to basically eclipse 25%. And again, some of the statutory numbers we're still waiting on to come out, but in our view and some of our calculation from our data scientists are coming up at that number is probably going to plot somewhere between 24 and 25%. So the red tick is actually going to just continue upwards.
I have noticed that a lot of our carriers are either acquired or are emphasizing their E&S holdings. So they'll own, our traditional standard markets will own a E&S carrier, and they're getting a lot better or more streamlined in pushing that business out there if it doesn't fit into the standard market side.
No, it's an amazing observation, and you're 100% correct. I'd go, and here's the red line that I was talking about relative to all of you who like regression analysis with some type of R squared at 91%, you can start to see that we're really confident based on that trajectory that we're going to see more and more of this risk being placed in the non-admitted markets. And Andrew, it's a really good point because I think it's a little bit of what came first, the chicken or the egg. You have consolidation in brokerage, and then as the consolidation in brokerage becomes more sophisticated about where they want to place the risks, they're actually also building out, and we're going to talk about this in a minute, they're also building out um, call it a wholesaler division or having a specialty division that also then has some delegated authority. So at the broker level, that choice is coming into where's the best place to put this risk. Now, you're absolutely right. The carriers to some extent responded to that and they said, well, hang on, we want a binder of all of your business. And if you're thinking about placing that risk in the wholesale or the E&S markets, place it with us. And the point you just made, Andrew, is 100% correct. We also then have the right carrier and writing company to do that. So it's going to be an interesting dynamic. And again, I don't think it's one that's going to change anytime soon.
Not necessarily the best thing because pushing it into the E&S, if they have any sort of enticement to do that, the commission differences and forms and that type of thing. But
Yeah, it's interesting because it's the reason it's attractive is because it's free of rate and form, right? And sometimes it's not as true in New Jersey as in other states, but you get unfriendly regulators who are not in a way. And look, this is not to cut on the regulators because they're trying to protect their end insured and their employee population and their employee base. And there's always the political aspect of it as well as far as where rate increases come. But if you have that dynamic of your mispricing risk relative to your standard and admitted lines forms, you almost have to figure out where to place that risk elsewhere. So it is a little bit of a, is it a positive or negative? I think from an overall industry perspective, being able to take risk, appropriately price the risk and place the risk is what we all do on a daily basis. And having more and more opportunity to do that, even though it might have some pitfalls associated with it, in my mind anyway, and by and large is a good thing, not a bad thing. Happy to debate that point as well. But just as we think about like the positives that are happening in our industry, that's another one. And I would say to continue, and this is not meant to be gee, does everybody know the different large language models and machine learning applications that are out there from an AI perspective, but we're continuing to see technology spend in our industry, both on the carrier side and then on the insurtech side with VCs and private equity money. Um, you can see just a couple notable investments. AI was all the buzz, especially in the second half of last year. And as we move into 2025, we don't see that disappearing. I think really the relative point here is practical application and how you all can be better at your jobs by looking at where all this technology spend is coming through and how that actually is going to manifest into better risk placement, lower. We have another dynamic in this industry, which I'm sure you all know of, which is we can't hire and attract enough good talent and what we need them to do either on the producers or on the service side. So continuing to think about where's the best way for some of this AI investment to come in. And the AI investment is truly across the entire insurance value chain. And you can see, again, if somebody has invested in one of these companies and there's an insurtech that you all love and I don't have on this list, I apologize, but I could only fit so many logos. I think by our last count, there was over 850 registered insurtechs in PitchBook, which is kind of the market leader relative to indexing and cataloging where all those investments are. So our sheet can fit 800 plus, but you can see across what I consider the four main pillars of the insurance value chain. What's interesting about this slide is if you then looked at all the insurance, the earlier stage VC and PE money and where that's being invested, it's actually all going into the distribution side of this. By all, I mean over double compared to any one of the other three pillars. So it's interesting when you think about digital MGAs. I'm sure you've all at some point seen the latest, oh, this is a really good digital interface and a specialty risk being placed. And in some cases, it's really clever. And in other cases, it's like, well, what are we missing here by not having the human kind of touch and aspect to it? But again, more positive than negative when we think about technology and investment spend coming into our industry. So continued strength in our industry.
Before we
But
move on, real quick, I'd just like to, if you don't mind, at our
please.
conference in June in Atlantic City, there is going to be an Augie Group meeting, and I believe even a presentation. Augie Group is a insurtech exchange, so this is where a lot of these organizations will be, and you would be able to kind of see the different types of things that are out there. At the very least, to see like kind of what's coming down the pipe. Maybe some of them haven't quite figured it out yet, but this is certainly something that's not going to slow down with, especially with the amount of capital, as you pointed out, that's going into them. And both PIA and Marsh Ferry are both, I believe, on the executive council for Augie Group. So that's a good plug for both of us, frankly, because it's coming like a freight train. So the hard part is just trying to figure out which one of these you got to be a part of.
Yeah, for sure. And it's a constantly changing landscape as well. So just kind of keeping your finger on the pulse of it. But yeah, the event last year, I think you guys also did an InsurTech event last year, or some type of technology panel last year, which I sat in on. And yeah, definitely for all of you that plan on being there at the Hard Rock, it's worth spending some time there for sure. So I got to my however too quickly, and I don't know if these next slides are going to be a shock to anyone conceptually, but when you actually start to see what it looks like visually, it's a whole other story. So if I told you all today that weather patterns were shifting in the US, I'm sure you'd all just shake your head and agree. What this is, though, it's a federal agency called the National Centers for Environmental Information. What they have been doing forever is tracking storms, and you can see it's a very colorful chart, but the storm type are the colored bars, and then obviously as you go over time, you can see where those storms are stacking up relative to the colors. So what do we what's the last thing we want in insurance? We want low frequency and we want low severity. And what this chart is telling you is over time, we're actually having more frequency and more severity. So when you just step back and you think about the overall um, cost of any one of these storms over years and the amount of these storms occurring, it's not good news. And I know we had some questions submitted in advance about California and North Carolina, and we're going to come to that here in a second too. But even before going into specific weather events that occurred in the past 6 weeks, you can see this really disturbing trend relative to our industry. And and these are truly unique billion-dollar plus weather events in the US over time. So the next one is just if you take that same map and you take a snapshot of 2024. So again, the key tracking here, and I should have mentioned, is that any one event cost over $1 billion of claims costs. And that's what the litmus test is to make it to this chart. And you can see that it's also not just geographically contained to one region, it's truly from coast to coast and everywhere in between. So whether you're talking about tornadoes in the Midwest, whether you're talking about the cyclones hitting and the hurricanes hitting in the Southeast, and now, as we know, kind of up into the North Carolina and Asheville area, which nobody expected. You're thinking about the severe winter storms. I have a client who's actually in the Pacific Northwest, and I can knowing that agency and that carrier had no idea that winter storm was coming, and it just devastated the area a year ago now in 2024, specifically around the Seattle. So it's not a positive trend, but it's definitely one that we continue to monitor. As far as other non-positive trends, nuclear verdicts, your brother and sister to the north at New York have basically the third most nuclear verdicts as a total number. And you can see they're also in the top 10 relative to the cumulative amount awarded. So this is a very disturbing trend. It's also one that we don't expect to go away. So, Andrew, we were talking a little bit back to why are risks moving out of the admitted market into the non-admitted market. It's because every time we have one of these nuclear verdicts and we have to then start to anticipate and actuaries price backwards, and if they have these claim costs that kind of shot their loss ratio up because of these one-off verdicts, they're not one-off verdicts. They're continuing both in frequency and in severity and cumulative number and dollars awarded in a very disturbing way. So definitely something that we're continuing to watch out for.
We could probably have a deep dive. Matter of fact, I attended a legal abuse symposium that really was that. It was a 2-day long thing about the basically everything that you're trying to do with tort reform, different plaintiff bar behavior, so jury anchoring and all these different things, the nuclear verdicts, the thermonuclear verdicts, and you know that type of thing. So it's definitely something that all the carriers, all the reinsurers, and all the even the giant self-insured markets are paying a lot of attention to right now. So.
Absolutely. And actually, I'm going to skip down too. So another trend, probably in the order of my operations, belongs right after nuclear verdicts is this continued rise in third-party litigation trends, right? And back in the day, I don't know if it's still appropriate to call ambulance chasers, but these people who are, and you're right, Andrew, in that you can easily look at Florida, and thankfully some of the tort reform there. But prior to the tort reform in Florida, like it was open game for anybody that had a lawyer and the lawyer wanted to go directly after the insurance company for massive loss costs relative to, probably something much greater than it should have been just because of the way that um the statute was written, just it had basically an investment class. So if you think about where we got this data from, this data is you as an individuals have the ability to invest in third party litigation funds and make a return on it. So even if you just step back and think about it conceptually from the opposite side of how could we even be talking about on any given year billions of dollars coming in, basically chasing alpha and looking for a return on that investment. So this chart has new commitments on the right through 23. Again, we haven't seen the 24 data yet. But then in total, the aggregate of assets under management for third-party litigation funds was $15 billion in 2023. It's mind-blowing when you think about the outcome of that is them looking for insurance companies to pay greater on claims than probably they were worth.
And the returns are immense for these things. We actually considered this particular topic as a deep dive in itself because it keeps coming up over and over again as we talk about carriers and what's kind of driving a lot of the casualty results. And my understanding is it's this concept isn't new, but the amount of data that the companies that manage it are getting a way more sophisticated with the use of AI, and to the point where they know the jurisdiction when as they know as soon as a judge gets assigned what he's probably going to do, and they can basically handicap a claim. So if the carrier is trying to settle something and they come in and say keep fighting, we'll fund it, and it's just going to increase the litigation costs on top of the ultimate settlements. It's just a problem that's eroding the casualty line. So.
Yeah, and I mean that's almost a perfect segue, and I promise I didn't pay you for that. For the first time now in a while, and especially on the casualty lines, we're talking about uninsurable risks. And as insurance professionals, I think we look at just about any given situation and say there's probably an insurable risk in there someplace that we could figure out how to price and underwrite. And now over time, we're starting to say, well, what is truly uninsurable for all the reasons that we've been talking about, whether it's the weather patterns, whether it's the unpredictable nature of verdicts, whether it's more money coming in and ambulance chasers looking for this ability to get yield and find alpha relative to returns on investments for third-party litigation. So this is just a handful of what we're tracking relative to potentially uninsurable risks. I mentioned it earlier and I'm coming back to it now. In addition to that, it would be fair to say that some markets are in fact softening. So what this slide is telling you is if you just look at some period over the past basically 4 years, so this was post-COVID, where the high was and where the low was in any one of these lines at the macro level, and then that delta. And this is all on a downward trend. So softening really across a majority of the casualty lines. So I would say at that point, everything we've talked about is 100% out of your control. So as we pivot into what is in your control, I do think these next few slides can be beneficial as you're thinking about, how do we focus on the things that we control, but at least mitigate the risks of the things that we do not control by being aware of them. I love this slide because it tells you a couple things, but the main thing is asking the rhetorical question, what is your plan? sell it. It's not why you're here. I'd have to believe. So then you have really two other choices. You can milk the business that you've built and consider it as a lifestyle business, and at some point flip the lights off and go home, or you can grow it. And why growing it in our view now is so important, probably more so than it was ever before. It's funny, 20 years ago, kind of when I was first thinking about this industry, like the old Nationwide model, Nationwide was out there basically recruiting captive agents with this value proposition that said, grow your book to $1 million and you'll never have to work again because you'll get the annuity stream of that at 95% retention as far as the year can go. So I'm sure some of you on the call have been around long enough to know that that was the old Nationwide stick. Uh, our view is that's the absolute poison in the veins of especially legacy brokers who are just looking at renewals and not thinking about how to grow in a meaningful way. And everybody else that's on the consolidating factor, all those 100 plus private equity platform investors that are out there, 65 of them are well capitalized in a way that they're actually doing acquisitions to get inorganic growth, is to build an organic growth machine. So what you're up against and what you control is your own organic growth as we go forward. So here's a couple quick tips. And if you this is not a Marshberry rule. It's I learned it in my MBA class, and it's one of those ones that we keep coming back to. But it's a really simple math, and it works every time. If you just grab your calculator and you plugged in this formula, the rule of 72 basically says if you divide 72 by your growth rate, it's going to tell you how many years to double. So the quick math on that is if you want to double your firm in 5 years, you need a growth rate of 15% a year to basically take you from either 2 million to 4 million or from 20 million to 40 million. You can also do the equation in reverse, like thinking about our algebra. And if you say, look, if I am growing it 2%, what's that going to be? I mean, it's going to take me 36 years to double. Or you can go in the other way, like I was saying, and say, look, if I want to double in 3 years, what do I need to do to grow? And in this case, the math is you have to grow at 25% a year. So what does that entail in our minds? It basically is a transition to a growth mindset. So organic growth, in our opinion, has truly gone from a nice to have to an absolute must have. We say this all the time. Again, we don't think anybody on this call is here because you want to necessarily sell your business. But if you run your business as if it's for sale, it basically gives you the luxury of not needing to sell it. So keeping that view on profitability, keeping that view on where organic growth rates are going to take you, figuring out how to onboard producers in a meaningful way. Those are all kind of the keys. And we'll talk a little bit more about a few of those here in a minute. One of the things that you can control, and it's the easiest calculation that we can provide, and anybody that follows Marshberry literature, we often talk about sales velocity. And it's as simple as taking all of your new business for the past year, the past 12 months, and dividing it by your prior year's in force block. Again, it doesn't account for rate, it doesn't account for exposure growth. It just is simply total new business divided by your last year's in force block. On average, a majority of the people that do this calculation that support and report their figures into Marshberry, they're getting 14% of sales velocity. The other thing that we basically do is to go from sales velocity to organic growth, which is what I was talking about on the other slide, is then you actually have to we lump everything into one column called leakage, but you think about rate, you think about retention, you think about compression, you take all of that stuff and you remove that from the just high level sales velocity metric, and that gives you your organic growth. Why is that important? So a majority of our average agents, and again, we have over $7 billion of premium running through this chassis now that we can report on average, basically are growing at 8.7% organic growth rate as of 9/30/2024. We then take quartiles. So top 25%, top quartile, they're actually growing at 18.2% organically. And more specifically, they're actually reducing their amount of leakage because they're actually going out and finding new PIF, new policies in force. And they're to some extent mitigating some of the rate that they're getting and some of the retention. And that is basically when you take our leakage calculation, negating the leakage and taking sales velocity and turning it into true organic growth. So it's definitely not impossible to do if you're sitting there and you have your calculator out and you're trying to think about what's the best way to grow at 20% and basically doubling your company every 5 years. This is another interesting slide is if you actually look back, what was interesting in 2009 for a couple of reasons. It was actually the first year that as an industry average, there was negative organic growth, and that was because of the Great Recession. But even then, our top quartile performers figured out how to grow in arguably the worst economic times in our history. And then from there, you can see just continued organic growth, both at the top quartile and on average across the board. Most people then, you have the conversation to say, well, grow at all costs. And, you can't talk about growth without talking about profitability. So one of the things we talk about a lot at Marshberry, we have a lot of terminology, is PPOG. So predictable, profitable organic growth. So not only are our best firms and our average firms growing, they're actually growing profitably. And what you can see here is on average, the EBITDA margin across both of those cohorts and with fair consistency relative to their ability to grow and do it organically. So it is definitely not impossible, and a majority of our clients are doing it and doing it well.
So I've sat through, not sat through, but attended several Marshberry events, either through the SIGs that you have in the Connect forums, the MB360s, and just knowing the venerable Mr. Wepler. And he's always good for a kick in the pants to make sure that you're trying to grow the agency. Otherwise, what are you doing here? But I think the biggest takeaway I always took away from it is just like, all right, well, why, if I'm going to grow at 5% and I'm profitable and I'm an owner of a, mid-sized agency, then what's the harm in not doing that? And I think the impact that he was really, really good at explaining is that your relevancy compared to these larger brokers that are growing through either acquisition and organic growth, you become less and less relevant every year if you're not keeping pace. So I think that's an important thing to kind of articulate why it's important for us to pay attention to growth.
Yeah, absolutely. You hit the nail on the head. And and look, one of the other things we talk a lot about, and Wepler does as good of a job as anybody, is that also makes your employees excited about coming to work every day, and it's not stagnant, and it's actually this really interesting place to come in and work. And who wants to work at a place that has no growth and doesn't double and doesn't have anything to really get excited about? So, as far as what you control, it's 100% organic growth, and then being able to do that profitably is key to the secret sauce and being successful for the long term. And now in our industry, again, we have a few plays in our playbook, but the ones that work really really well, and it's the importance of new producers and then those new producers producing. One of the things that we talk a lot about are non-producing producers. This was a survey that was actually done a few years ago that we went out and we pulled our clientele and said, like, what is your biggest hurdle to growth? And the number one responding answer was non-producer producers. And like, we didn't even know what that is. We have to figure that out. Number two is lack of producers. That's something that we're not seeing changing. Again, just figuring out how to attract that top talent into our industry. And then you could see kind of the next four or five here that were really the biggest impediments to growth during our survey. But if you think about the non-producing producers and the lack of producers, these are things that you can directly control by reinvesting in your producer block. And again, no shortage of new terminology here at Marshberry, but we track that through something called NUP, which is net unvalidated producer pay. So again, you can quickly take out your calculator, figure this one out. This is a percentage of revenue. So again, if you think about revenue and you think about how much I'm reinvesting in my unvalidated producers, so you give them a draw, I'm assuming. And so that draw would be against what we consider NUP and UPP. And you can take your revenue, you can divide by how much non-validated producer expense you have. And if you're not somewhere between 2.5% and 5%, we'd argue that you're underinvesting in your producer block and what it's going to take to go forward. Andrew mentioned it, and similar, we know for a fact that the top 100 brokers are probably somewhere in the 5 to 7% of reinvesting into their unvalidated producers, and then making sure that they have the tools and the training and everything else that's going to take those unvalidated producers to become successful and validate, and then they go and they find that next batch of unvalidated producers. So that cyclical reinvestment in the industry is key. We only had 45 minutes. I could talk probably for another hour. I'll leave it with these next couple. One, truly the greatest industry in the history of humankind. 15-year super cycle that we've been coming on the back end of. It's been an amazing time to be in this industry. There may be some headwinds to our tailwinds, but again, by and large, the the offsetting technological investments, the offsetting capacity coming back into our industry to offset some of these risks and storms are there. We have amazing, I would say, runway in front of us going forward. So we only had 45 minutes. I was asked to keep it at about 45 minutes because we're doing another 15 of Q&A. One of the things I talked to Andrew and Aaron and the entire PIA New Jersey team about, if any of this resonates with you, if you're interested in more, if you've already heard about Marshberry in the past, we run something called MB360 once a year. We do it in three different cities, New York, Chicago, and Vegas. And in talking to the group, what we wanted to do was offer to everybody that was here, come to Marshberry 360, and through the PIA, they're offering and we're figuring out a 50% discount code. So if you all either click on this, or I think we're going to circle back around, Andrew, with an email that has a couple of these things as well. It's early bird registration, so it's under $500 right now if you do it before April 1st with this PIA 50 code that I have on the screen. And here we actually have a full day. The full day agenda, the morning is really consolidation trends that we're seeing in the industry, which we didn't talk about here because we didn't have time. But then the afternoon is 100% focused to those key, what you can control components of my presentation. So organic growth, producer training, what is NUP? How do you use sales velocity? How do you have an ROI for your producers? We cover that in a 4-hour session in the afternoon, and we're doing it in the city on May 6th. So through the PIA, and again, thank you to the PIA for the 50% off code there, to make sure that anybody that was really interested in this can go ahead and we can continue the conversation. And I'll personally be in New York as well. Look, if you want an excuse to go to Chicago or Vegas, please, this registration code works there too. And we can figure out, I don't know if I'll be in those other two cities, but I'll definitely be in New York to talk about it. So
I have personally attended the one in New York, I think 3 or 4 times, and it is a full day of a lot of what we touched on, but in a lot more granular level. So there's multiple presenters, and there's people from the industry, people from some of the private equity firms, and kind of what they're looking at. And just, it really gives you a lot of information. And that's really what I think we're trying to accomplish today. And then just kind of articulate the importance of this data, which is, you know, I want as much data as I could possibly get to help you run the organization, benchmarking tools, all the different things that you can offer. And that's all in there. And plus the motivation of like, I got to get off my rear and get moving on the organic growth pieces, because if I don't, I'm just going to become less and less relevant day by day.
yeah, the growth mindset, we double down on that for sure, understanding what that looks like. You know, the data component you mentioned, Andrew, is an interesting one. A lot of times you think you're doing really well at an absolute level, but on a relative basis, it's kind of shocking sometimes when you step back and see what other peers kind of in that same revenue band is where you're operating, what they're doing and how they're doing it. Like if 30% EBITDA margin is mind blowing to you, like where is that leakage on your balance sheet or on your income statement, and where does that money go? We have a whole data set that we can help you with. It's actually called financial snapshots, our easiest way to do that, right? Where if you come in and you say, hey, let me think about financial snapshot, like where am I relative to a band of revenue? And so, you know, to some extent, you have to give us your financials in order to do that. One of the things we talked about at the PIA in preparation for this is if anybody's interested in a financial snapshot from Marshberry, in our follow-up email, I'll send a QR code out for that too. We don't have it here in the pitch, but that's your best way to like take some of this and translate it to, all right, well, where am I growing? What is my current expense base? And how does that actually compare to a segment of peers? Now, we never compare you to somebody else specifically, but we compare you to a band of other nationwide and Northeast type firms in that revenue band in that region. So again, if that's something that's interesting to you, we'll make sure a QR code is included in the follow-up email that we're going to send.
So I can share that we as an agency do use the PHP report, which I believe is perspectives and high
perspectives for high performers. Yes.
high performers. And that's a little bit more of a granular level thing. But I believe the snapshot is just more of an overview, which frankly is where I spend most of my time looking at it anyway. Is really just revenue per employee, and am I overstaffed or understaffed as far as salary in my service departments and all that type of thing. And then again with the producers and non-validated producers, and where do I stack up with the average weighted shareholder age and that type of thing. There's so many different aspects that, and they also funnel up to that PIN number, which is the peak.
Yeah, performance indication. Yeah. And so what Andrew's talking about there is the next level of advanced analytics. We really believe that data drives decisions in the most meaningful way. So once we get by, like, okay, let's just snapshot our business and where do we sit today? Again, Andrew and some of the other people on this call actually are more subscribed into that next level of advanced analytics through Marshberry called PHP. Again, anybody that wants to have that conversation, even going beyond a simple financial snapshot, I'm available. I had my contact information. I'll put that back up here in a minute, as well as Andrew and Aaron or anybody else at the PIA can obviously get a hold of me too.
So we did have another question that popped up in the chat.
Sure.
As weather and nuclear verdicts continue to trend up, how many years of quiet action do we need to see to offset that increased risk?
Yeah, so all due respect, if anybody on the call are actuaries, I have nothing but the highest respect for actuaries. But pricing actuaries, I think, have one of the toughest jobs in the industry, and that is how much of their backward-looking data should they be incorporating into their future-looking pricing algorithms. And I would say the nuclear verdicts piece of this is probably one of the most challenging. Like, to some extent, you can even predict weather patterns, right? And to some extent, we can start to see where exclusions are going to come in on admitted lines. And, as we think about stuff going on to the excess and surplus lines, that's free of rate inform, like all of those things to some extent, based on where we know today, we can probably price for, and the pricing actuaries and the underwriters can price for going forward. The nuclear verdicts is a big one because we just have no idea. And the nuclear verdict by definition has no upward bound. And so it's really hard to price for any one of those. And what's more scary about that is it's a continuing trend across all 50 states with really big dollar figures behind it. So I think it's anybody's guess relative to where that all shakes out. Tort reform would go a long way. Florida's already kind of leading the way on that. I think its carriers are continuing to think about more exclusions in their policies, which nobody likes exclusions in their policies, but the flip side of that is then it becomes very apparent that if it wasn't covered in a legal document, which is an insurance policy, then you can't sue for it. So, it might be more exclusions coming through that as well. But yeah, time will tell. It's going to be a tough one.
Yeah. So the property, I mean, the weather is obviously property related and in a lot of ways, there's a lot of issues to deal with the weather patterns and things like that. But in some ways, it's a lot easier to kind of track because they kind of know what their exposure is, and they know almost immediately after the storm or whatever other issue that they kind of know what it is. Where the casualty is spread out across the entire country in every different jurisdiction, and even inside states, different counties regulate things and permit certain behaviors from a plaintiff attorney and that type of thing. So it's just really hard for the carriers to track all that thing. And like you said, the tort reform, that's going to be state by state because the federal government really doesn't oversee the individual civil courts in the states. So it's really difficult for them to track, but they are getting a lot more granular. I mean, even when I started in the industry, there was, hard and soft, and now it's really, hard in this particular area for this class of business in this jurisdiction, and they're really getting a lot more granular in how they look at risk. So I think that's
absolutely.
But I would encourage anyone that has any other questions to put it in the chat as we have Brian. He's a great resource for the agents and carriers.
Yeah, and so as we're waiting, if any other questions come up, I think just to complement the last thought there, Andrew, I said it earlier, all politics is local and all insurance is local. And I think one of the things is we see more technology come into the space, more precision and data around individual risks being priced correctly is probably a trend that we should watch out for. In other words, the introduction of parametric insurance, the introduction, even on some of the casualty lines like cyber, figuring out like how do you actually have, an entire infrastructure being secured across and just different ways to be unique and individual relative to the risks that you're writing as opposed to, our industry to some extent um, looks at macro trends and looks at macro regions and even within zip codes and then tries to make their pricing decisions for some individual policies to actually then, pay off and on the claim side, pay off individuals as you have the cumulative bucket of surplus and loss reserves growing. So I do think individual risk placement and individual insurance is actually something that's going to be accelerated with technology specifically. So we'll see if that crystal ball prediction pans out or not.
You mentioned parametric insurance. I just happened to have been reading about that the other day. So if anyone's not familiar with it, it's a sort of a new concept. I don't know if it's new, but
It's old and then it was quiet and now it seems like it's back in vogue. It's kind of like bell bottoms.
what I was reading about was more flood. So effectively, there's some device that is tamper-proof, according to them, where if water hits a certain side, it automatically just triggers coverage. So you just have the full amount of whatever you purchased at that water level, and it automatically pays that you can use to pay for anything, including business interruption and everything else, which I know is a big gap for flood insurance. And then I do know that there's other things similar to that with wind. So they have something that will monitor the wind. If it hits 100 miles an hour, it automatically triggers coverage, even if you don't have damage. It's a very interesting emerging way to.
Yeah, absolutely. I ran into somebody in the InsureTech conference which actually was working on a captive taking the risk as well as the parametric on cat exposed property in California. Like that was the business that they were going after, which I think everybody else would be running from that business. But these unique kind of, again, with the help of technology, these unique risk placement kind of devices coming to fruition.
So lots to talk about. This presentation will be available afterwards, and I believe we're going to be sending a follow-up email that'll have all these QR codes and links to certain articles that Brian has written for PIA, our periodicals and magazines, and you'd have access to some of these other things. And if there's any other questions, I'm sure you can reach out to staff at PIA, and we can get it to our staff, our resource center, and/or Marshberry.
Great. Well, thank you all. I appreciate you taking an hour out of your day to listen to me.
Thank you very much, Brian. I don't see any other questions in the chat, so if there's nothing else, I guess we can wrap this up and hope to be another deep dive later on this year. And this was a lot, I know. We tried to touch on a whole bunch of different concepts, so I really appreciate it, Brian Marshberry, PIA, our chairs of business issues, which is the driver of this. So Lisa Ham and Bill McMahon, Aaron Levine is the vice president they report to. So thank you very much for your time today. And hopefully you guys got something out of this.
Great. Thank you, everyone.
Great job, guys. Thank you so much, Brian.